All right, thank you, Ed. We want to begin by thanking the editors for including the paper on the program, Shiva, of course, for discussing and giving us many useful pieces of feedback along the way. Also want to acknowledge that Mike Minnis was a co-author on an early version of this paper. Mike decided it would be more relaxing and enjoyable to be faculty dean at Chicago than to do another paper with me. We still appreciate his contributions nonetheless. So let me tell you why we're doing this and why now. So our profession is facing a lot of big changes. So technology is creating new tools that can sometimes substitute for accounting. There's concerns about displacement in the labor market. Facing such changes, it's natural to ask, what is the economic role of accounting? Take a step back and think about who uses accounting when they don't have to. The second is that private capital markets have grown quite a bit over the last couple decades. You've got the quote here from the Goldman Sachs CEO saying that the reasons to go public are getting pushed out. And the early evidence that we have from the private capital markets is that accounting is just used inherently differently than in public markets. Third is that there's growing awareness of spillover, some regulation that are based on ownership or size. And fourth, over the years, you hear it so many times that private firms are kind of historically understudied relative to their role in the economy. Well, now we have a lot more data and a lot more tools for studying them. And it's sort of a natural time to take a step back and ask, what do we know about this setting and what are the promising areas of future research? So let us first acknowledge a couple other related surveys. So many of you, particularly in the banking literature, will know Berger and Udell. They have a conceptual framework for SME credit. What's different about what we're doing? Well, we're not focused just on credit. We're not focused just on small and medium enterprises. Obviously, a lot has also changed since 2006 when that survey was written. There's also the Buselink et al. Survey and ABR from a couple years ago. This is primarily focused on earnings quality issues and data issues in Europe. What we're doing is, I think, a lot more conceptual. We're interested in the economic role of accounting. And that particular interest is going to bring us beyond Europe, particularly to the US, where a lot of the accounting choices are free. They're not sort of dictated by mandate. And so when you do private firm research, it's inevitable you're going to get a question like, why do we care? Why do we care about these private firms that, maybe a manufacturing firm that has 150 employees? Why is that interesting to study? Well, at least one answer is that this is sort of how our economy looks like. The private side of the economy is full of firms that look exactly like that, and we want to do research that speaks to the way that our economy actually looks. Obviously, there's a lot more private firms than public firms out there. When you start thinking about macro statistics that we all care about, so GDP, job creation, the number of workers, taxable income, however you measure it, you end up with the answer that roughly half of the economy is driven by private firms. And this is something that's not unique to the US. You look in the EU, you look in Japan, you get sort of the same answer. And if anything, the way that these macro statistics are compiled, it sort of biases against private firms. Usually a lot of the prudential authorities that are providing the data here, they don't actually observe ownership type. They're like counting the number of employees or measuring the number of assets. There are a lot of private firms that have more than 500 employees or more than 10 million of assets. So if anything, these figures sort of understate the role of the private firms in our economy. I think a fair follow-up question to this is say, all right, Andrew, you've convinced me that this is a big setting, but does it matter? So in other words, if I don't have private firm data, am I going to get the wrong answer if I go to a research question? Am I going to miss something? And it's often the case that, yes, you will. So I'll give you a few examples of this. So obviously, the proprietary cost literature is something that's central to accounting. You need a measure of competition to test that. And what's interesting is that Ali et al. have a series of studies saying that if you only use the CompuStat data to measure competition, the industries that look really concentrated are, in fact, very competitive once you consider private firms. And the converse is also true. There's a lot of interest in auditor portfolios as a way to measure auditor workloads and auditor expertise. DeFond and co-authors have a recent paper showing that you sort of get the wrong answers if you're only looking at the auditor's portfolio through the lens of public firms. There's a large macro forecasting literature in accounting. Shiva has a paper here, and maybe he'll talk about it. It turns out if you're trying to predict GDP next year, private firm earnings do a much better job of predicting next year's GDP than public firm earnings. And you can go down the list. There's a lot of examples of papers that show that, it really does matter if you're only able to study public firms versus both public and private. And the common theme across these studies is that there's just different frictions at play. There's different regulations. There's different choices. And that's why it really matters whether you can actually observe both. And so what we're going to do is we're going to build our conceptual framework around these differences. And it's going to focus around three choices. So these three choices are going to kind of organize the literature: information production, information verification, and information dissemination. And the idea is that these are pretty distinct activities. They happen sequentially, and there's distinct regulation, and there's distinct literature that touches on them. And to kind of illustrate how this works, we're going to give you, walk you through the contrast between private and public firms. A typical private firm, let's say, has 25 employees. Think of any given public firm. How are they going to differ across these choices? Well, private firms, they start from minimal sunk cost investments in their accounting, personnel, and systems. Okay, so they basically only, in many cases, they only have to do a tax return. They don't have to do much else. And so the choices they face are both along the extensive margin and the intensive margin. And so by an extensive margin choice, I mean they're choosing, should I use accrual accounting? Should I follow the local accounting standard? Should I get an audit? Should I disseminate? Whereas a public firm, they're generally regulated across all of these dimensions, and they have very sophisticated information systems. And so they're making what we call like pretty narrow intensive margin choices. They might be choosing, should I adopt a given accounting standard early? Should I choose one large auditor over another? They're not making the more fundamental choices about, should I use accrual accounting, for example? Okay? Obviously, the audience for the financial information that these two types of firms is going to differ. And what's going to be really important to, I think, interpreting the literature is that the frictions at play are going to differ too. Okay, so with private firms, the relevant frictions are limited visibility, they're financially constrained, they're often not very sophisticated. Whereas with public firms, they face a lot of regulatory scrutiny, litigation risk, there's capital market pressure, concerns about short-term decision-making, and agency costs, given the separation of ownership and control. Okay, so this is the conceptual framework that's going to organize the literature. Rather than give you like a bibliography, what we thought we would do is walk through a few studies in each of these three areas, and with a focus on a question that we think would be relevant to everyone, whether or not you do private firm research or not. So one question I think we would all care about is, what are the trade-offs behind producing more financial information? Well, the challenge of kind of going to a public firm setting with that question is that, as we mentioned earlier, like there's a lot of fixed cost investments that these public firms make. They're already very transparent. They're already sophisticated. With private firms, you can ask very fundamental questions like, what does accrual accounting do to my financing outcomes? Or thinking about management accounting practices, how do they evolve with a startup's growth? In terms of information verification, how important is assurance to financing outcomes? Again, the challenge is going to be that the public firms start from a pretty high place, right? So all the public firms have to be audited. De facto, they're going to pretty good auditors, and there's sort of a minimum level or there's a high floor for reporting quality. This is something Jerry Zimmerman talks about in his essay about a decade ago. With private firms, there's a lot more variation. So some of them will get audited, some of them won't. Some of them will choose some intermediate level of assurance. There's also changes, particularly in Europe, in the insurance mandates. And so you could explore it with a private firm setting. You could sort of go after questions like, what does a voluntary audit do to my financing outcomes? What does it do to my operations? Or think of the signaling hypothesis, right? So this is one of the foundational theories in auditing is signaling. It's hard to think of how to test the signaling hypothesis in a public firm setting because everyone has to get an audit. Okay? And so there's papers that sort of test the signaling hypothesis in a private firm setting. In terms of dissemination, starting to get thirsty. So how does product market competition interact with disclosure decisions? So a limitation of the public firm setting is that you're not going to see the full set of competitors. With private firms, if you have a sample that includes private firms, you do see the full set of competitors, and you also can abstract away from the capital market incentives that can contaminate these tests of proprietary cost theories. And so there's, Matthias has a series of nice papers looking at how mandates affect innovation, profitability, competition. There's work by Joachim Gassim and Maxime Yoon looking at whether firms are even aware of their disclosure decisions and how it relates to the nature of competition. And so this is just sort of an overview of our literature survey. What about the takeaways? So the main takeaway from all of this is that private firms provide a unique insight into the economic role of accounting. To make this point, humor me for a second with an analogy. I want you to imagine that I'm an epidemiologist, and I think that I found the cure to a really bad disease. And the way that I go about testing that cure, whether it actually works, is I'm going to find someone with a mild form of the disease, and I'm not going to give them a full dose of my treatment. I'm going to give them like a microdose. And you would probably say to me, that's a really crazy way to test whether your disease or whether your cure actually works. Now, there's some hyperbole in this, but this is how some accounting research is actually done, and it doesn't do justice to our field. And let me give you some examples of this. So, Leutz and Verrecchia, one of the most cited papers of the last 25 years, they're motivating this from the perspective that there's a pretty clear theoretical link between disclosure and the cost of capital. So some of the theories might differ in the channels, but that prediction is pretty clear. Up until their paper, the empirical evidence was mixed. And the reason that they argue that the evidence is mixed is that people are taking that theory to a US setting where the disclosure environment is actually really, really rich. Okay? And so in some sense, the empirical effort is set up to fail. Verrecki actually ends, so his really influential essay, the last 2 paragraphs of his essay talk about exactly this, that we need to be very thoughtful about how we go about testing the theory. You can make it a similar case for some of the audit literature. So we have these really rich theories about how auditor characteristics matter. So auditor size, auditor reputation, auditor expertise. The difficulty of taking those theories to a public firm setting is that in practice, most of the public firms are choosing a big N auditor, okay? And the big N auditors look pretty similar across these dimensions. And on top of that, public firms have a really high level of earnings quality. And so the danger of just sort of blindly taking some of these really great theories to a public firm setting is that you might not find anything, not because the theory is wrong, but because there's just not enough variation in the data. You can go to the management accounting literature and think about how most of these public firms have very good information systems, right? So take a given management accounting practice. Let's say customer profitability analysis. Well, every public firm is probably going to be doing it. They might differ in the metrics they look at. They might differ in how frequently they do it. But if you only look at those margins, it's going to look like a trivial decision. Whereas if I'm interested in the full effect of a given management accounting practice, show me a firm that wasn't doing it, and then show me a firm and then show me what happens after they start doing it. And so the common thread across all these examples that I'm giving you in disclosure, in audit, and in management accounting is that we often lack the variation in the public firm setting, and this leads us to understate the economic role of accounting. And so the biggest takeaway that Darren and I want you to take from our survey is that precisely at a time when our profession is facing these existential questions, a lot of our literature doesn't do justice to the economic role of accounting. The second takeaway is that we don't have a lot of descriptive evidence on even just basic accounting choices that firms make. I teach MBAs, or I have been teaching MBAs until recently, and we get a lot of entrepreneurs that come through Sloan. And it's natural for them to ask, like, Andrew, I understand what you're teaching me about accrual accounting. I understand what you're telling me about audits, but who actually uses this stuff? At what point in a firm's life do they start doing these things? And how do they differ across industry? I'm sort of embarrassed to say that, even though I'm one of the main people in this literature, we don't have very good answers for them. And I think there's a real danger that when we don't have this kind of evidence, that instead it's people's priors that end up shaping teaching and shaping research. And over the years, having done a number of these private firm studies, I can tell you that even very famous senior people in our profession have very different priors about basic facts about how often firms are audited. And so, I've asked a number of our colleagues, why do you think it is? Why haven't we established a lot of these basic facts about our field? And they say, it's hard. These firms, they want to be opaque, and you really have to, come up with creative ways to get the data. This is what other researchers do in other fields, and I think we have to do the same thing. I mean, the people who study ants have figured out a way to estimate how many ants there are on Earth. Okay, so if they can do that, we can figure out. Give me a rough estimate of how many how many firms are using accrual accounting, for example. Diabetes is another interesting example. The challenge with diabetes is a lot of people who have it aren't aware they have it. Okay, and so they need to rely on interpolation to figure out that number. Why is that number important? Well, if I study diabetes, I sort of want to know how big of a public health problem is it? How much should we spend on diabetes research? Doing that basic descriptive evidence helps you answer kind of important questions about your field, and it's important to our teaching. We ought to know who's using the stuff that we teach. The third takeaway is that there's unintended consequences of regulation based on ownership or size. So just to give you one example of this, when you're a regulator, one thing you always worry about is the compliance costs, right? So take an example of emissions reporting. You might exempt the smallest firms, or you might exempt the private firms from emissions reporting because there's a big fixed cost of compliance. Now, the tricky thing that comes with that is that if you only make the public firms report their emissions, then you're going to get what I think Hans and co-authors are calling, brown capital reallocation or regulatory leakage, where all of the dirty assets just go to the private side of the economy. And you might very well end up with more pollution than what you started with. And so I think that this is a very common way to do regulation based on ownership or size. I think we're not saying that it's wrong, but it creates unintended consequences that are interesting and worthy to study. And the fourth is that generalizability is just really hard to assess. We don't think it's so simple that, well, public firms are big, and the public firm literature in accounting is big, and therefore public firm studies generalize. It's also not so simple as that private firm studies may have these advantages that Darren and I are talking about, but we want to be very upfront that there's a lot of private firm studies that shouldn't generalize to public firms, just given the nature of the choices that they face. Okay? And so maybe a more constructive way for us to think about generalizability is let's think of the frictions and the theories and the choices that are at play. Okay? And this is hopefully something that people can get out of our study. In terms of themes for future research, so we identified a number of them we think are really promising across all three areas. So production, verification, dissemination. One, we clearly need more descriptive evidence. So just in terms of what basic stats about what firms are doing and determinants. Second, we see real promise in research that studies accounting choices in developing markets. So Marcella has a nice paper on the program related to this. I know Thomas Rauter, Remy, and others are doing work in this area. It's interesting to look at what those choices look like, but also to link those choices to economic growth in the institutional environment. Third, so what's sort of funny is if you think over the last 20 years about the most prominent fraud cases, they've largely been on the private side of the economy. So this is Madoff, Theranos, FTX. I've been updating this slide the last couple weeks as there's been one after another private capital fraud. But I think we don't have even a basic sense of what kind of internal controls do private firms use? What sort of governance systems do they have? What sort of audit choices are they making? So this is sort of an area that I think is ripe for more research, especially now. The fourth one I'd say is a lot more conceptual. Okay, so think of the studies that say, all right, you've got two firms. One of the firms is audited, the other's not. The firm that gets audited ends up with a lower interest rate. There's sort of two classes of explanations for interpreting these studies. So one is, I'd say, the dominant one in our field, which is this hardcore optimal contracting perspective, which says that these two firms are sort of rationally trading off the interest savings and the cost of the audit and the other information benefits. I think there's another perspective here that actually doesn't get enough attention, which is what I'd call the management practice view of this choice, of this sort of choice, which is that there's a real role for processing costs and learning. A lot of the managers at these private firms, they're not super sophisticated. They don't have MBAs. They might not face a lot of product market competition or capital market pressure. And so then there's room for things like cultural factors and manager fixed effects to influence the choice. Fifth, so the role for new financing technologies and alternative markets is something I think we really should pay attention to. To give you one example that I think many of you will be familiar with, there's Toast, right? So Toast is the point of sale system that a lot of restaurants use. Turns out Toast is one of the fastest growing lenders in the country. And all they're doing is that they can see your point of sale system. They see how many cups of coffee you sell each day. They see the average entree size. They see the traffic in the restaurant. And that's it. They lend on that basis. They're not asking you for your tax return. They're not asking for your credit score. They're not asking for your financial statements. And so when you think about the private side of the economy, you remember these are largely voluntary choices about producing financial information, getting audited. This is a natural substitute. Maybe it's a complement too. Maybe Toast is using financial statements to sort of calibrate what is the right amount, what is the right rate to charge, and what is the right loan size. Six is that there's a whole host of regulatory issues that are affecting private capital markets and private firms. Some of you might have heard proposals that we should be letting retail investors in their 401k trade private equity, private debt. What sort of disclosure mandates might accompany this? There's debate about big versus little gap. And so there's sort of this recognition that many private firms are pretty simple, imposing what we call big gap on them, which has a lot of complexity that reflects the public firms, might not make so much more sense. A whole bunch of regulatory issues, and I think there's room for accountants to sort of add to the discussion here. We conclude the paper by talking about data opportunities. I'm not going to go through the full list here, but we're sort of identifying methodologies that people are using that are really creative to come up with ways to observe firms that are hard to observe by design. And so to conclude, it's sort of hard to escape that we sort of have this tendency in the accounting research to default to public firm settings. And this is not, we're not trying to be overcritical with this comment. It's partly due to historical data availability advantages, but the important thing is that these advantages are diminishing. It's becoming a lot easier to study private firms. And if we sort of stick to this default of only studying public firms when we have a research question, we're going to miss half of the economy. That's what Table 2 says. And more importantly, and this is sort of the ball quote that motivates the paper, it's going to widen the gap between theory and empirics, and it's going to understate the economic role of accounting. And this all links back to sort of the lamppost critique that many of you have seen. There's a real danger here that if we only go to where the data is convenient, whether it's public firm data or private firm data, we're going to understate the economic importance of our field. And that's all I had. So over to you, Shiva. Oh, you probably want the microphone,
yes,
right?
I do. That's what I was looking for. Thank you.
It's on.
Firstly, thanks to Mark Lang and Joanna Wu for inviting me to give this discussion. It's a pleasure to be here. I gave a discussion about nearly 18 years ago, and that paper was discussing Doug Skinner's work, and he was the JE editor at that time, and I had just gotten my tenure, so it was a lot less comfortable than what it is right now. So now I can just go Andrew and Darren's papers, just split it apart, which I'm not going to do. But it's a wonderful paper, so I enjoyed it. In fact, Darren just came to me in the morning and he said, Shiva, I'm very disappointed with your discussion. I sent my slides to them, and he said, I'm very disappointed with your discussion. Why is that? Because I agree with everything you say in your discussion. I can't disagree with you on anything. So that's where it is. I'm going to come and give a view which is somewhat complementary to what they are saying, but we both are converging towards the same objective at the end, and you will see that. So a little bit of evolution of the private firm accounting research as I know it and as I have seen it, but also there is some information here that many of you might not be aware, so there is an interesting story to it, which I just wanted to share. So I finished my PhD in 1996, okay, and before that, if I had read any paper in finance and accounting, I had not seen a single paper which used anything more than 15,000 unique firms. Okay, this is not firm years, unique firms. And that was the literature, empirical literature all that time. And then I moved to LBS, and at that time I was just saying, let's look at some interesting data in the European context. I was wandering through the LBS library when I came through the CD-ROMs which said private firms financial data. And I couldn't believe my eyes when I saw that, because there was almost no literature that had looked at private firms. There were a few finance studies, and when I'm saying no literature, it's all, I'm restricting myself to the top journals. Okay, there were a few in the B-tier journals, so on, but I'm restricting myself to the top journals and also looking at larger sample evidence. So I said, what is this private firm data? And so I put it into the computer and looked at it, and it gave me a list of over 100,000 companies. And I couldn't believe my eyes. I said, gosh, this is going to get me my tenure at LBS, hopefully. Okay? So I started working on it. I started downloading it. And as I started downloading it, I realized it's not suitable for research because it didn't have a time series. So I started calling the data vendor, that was Jordan's. Jordan's is the data provider for Bureau Van Dijk. So most of the people who work in private firms right now, they know Bureau Van Dijk. They are the providers for Amadeus, Fame, etc. But they are more the front-end software provider and the marketing team for it. The Jordans are the ones who actually collect the data. So I started talking with people at Jordan's, and they were very nice. So they started communicating, and they gave me some information, and I told them this is what you should do with your data for making it more accessible to researchers. This went on for 3 years. Okay, in sense, it was good because they were sharing some data with me, but it was also bad for me because every time I downloaded data from one CD-ROM and the next version, they had incorporated my comments, and it was a completely different format. So merging them and all was a huge headache. But anyway, eventually I put all the data together, and it took me 3 years. And in 1999, I had the data, and I had the guts to go and talk to Ray Ball at that time to say, I've got this data, I'd like to work with you. And he was, as a gentleman as he is, he said, okay, I will work with this young researcher who has 0 publications and see what comes out of it. And that's where our partnership started. So we published our paper in 2005, and then I also had another paper with Paul Cheney and Deborah Jeter in 2004, and we used over 100,000 firms in that. Okay, so that was a huge jump in the number of firms that were covered. And soon afterwards, the Amadeus database also became available, and Bergstahler, Hale, and Lloyds, they wrote a paper, Lutzi and Christian. Okay, so they all wrote this paper, which was starting to use the Amadeus database. So they pushed the private firm with large sample to an EU-wide context. And there was also, a little bit after that, there was some descriptive study Ali and Johan had done using accounting review. They were using small sample here again. It was not large samples. And Minnis also had his first paper in 2011. They were all using US. For the first time, the US data was being used in an accounting context. The US data had been used. Rajan and Peterson had all done some work in the credit side in early 1990s. But for the first time, I was seeing studies in accounting that were using US data. And more recently, afterwards, there was this emerging market data that was made available through the World Bank, and Chen et al. Were the first to use it. So this is some background to how the private research has developed, and it's still 25 years, but number of papers in this is very small because it's hard to work in this area. Data is hard, and you can't use a difference in difference analysis anymore in this one often. So there are restrictions on that. So let me also tell you what this review is trying to do. Okay, so the review focuses on empirical research. Okay, so there is almost no theory that I'm aware of. I think I saw one theory paper on private firms recently, something to do with opacity of shareholders, etc. But not much inside of theory. So this focuses on empirical work, focuses on accounting research, and focuses mainly on the US. They claim they focus on the US, but they also cover quite a bit of other countries' evidence as well. They've done a phenomenal job of motivating why we should study private firms, and I completely agree with it. I'm not going to go through that again with you. The way the review is structured is they have 3 parts to the paper, 3 main segments to the paper. The first one starts to say, how is the information produced in private firms? And then they go on to say, how is the information verified in the private firms? What's the benefit of audit, and what's the consequences of having audit in private firms? And the last part talks about how is the information disseminated by private firms. I'm going to focus a lot more on information production, but it has implications for verification and dissemination. And the study also does a nice job of talking about what are the various sources to get the private firm data, what are some of the ideas you could use to come up with data for work in private firm research, and finally it provides discussion on the challenges associated with it as well. Okay? All this is good. And in terms of writing this review, Andrew first approached me a long time ago when the editors had requested him and Mike to write up this review. He approached me and said, Shiva, can you give me some ideas about what all should be in the private firm? And I thought, my goodness, this is a big headache for anybody to take on. Why? Because private firm is not like any other literature where there is one paper neatly follows another study. One is based on building out of another one. This is not like that. This is a lot of disparate studies that have been developed. One is in the context of Europe. Another one is in the context of China. A third one is in context of US. How do you bring all these together? And they're using different firms. And then you have to create some kind of cohesive theory that combines all of these. So I was like, I don't know how you're going to do this, but here are all the topics that you can cover in your literature. And I was laying it down to them. And not only that, if you looked at the literature, there is no theory to guide how the framework should be. And there is also not much by way of descriptive data. So whichever way I started looking at it and started thinking about it, it was a mind-boggling job for me. But the good thing is I wasn't writing the review. I just had to give some guidance to these guys. Guidance as in what I thought was private firm research. And there's a lot of work that's also been done in the context of mergers and acquisitions, IPOs. So if you really think of the private firm before they put it together, it was like you could talk about IPOs, you could talk about private firm mergers and acquisitions, so on. But they have neatly drawn the lines as to what they want to cover. And again, kudos to the authors for doing all that fantastic job. Okay. And yet another problem with private firm is, what is a private firm? If you looked at the literature, when we look at listed firms research, it's very easy for us. Oh, when you talk about we use US listed firms, we know you're using CompuStat data. We know you're using CRISP data. Okay, it's the entire population that is analyzed. But when I say you're looking at private firms, what's a private firm? Are you talking about a limited liability company? Are you talking about a small vendor with 5 employees or even 1 employee? What is a private firm? Very hard to define it. And the authors, again, they have done the best job that they could on this because the studies in this area itself are so varied. What they have decided to do is say, let's exclude what are not private firms. Okay, and what are those which are not in the private firm arena? If it's listed in any major stock exchange, if it's a non-profit organization, and if it's a government entity. So they said, let's exclude these, and any other research which doesn't look at these kinds of firms, I'm going to bring it within my review. Okay, so that's how they've defined it. But imagine, this is going to cover a wide spectrum of companies. And when they talk about the research in the framework that they have presented, a lot of the times they actually have in their minds limited liability firms which are relatively large. Okay? They say we are looking at firms which are medium, so on, but in my view, it's much more of the larger private firms that they have got. And I'll tell you why that is the case. Because their views are also influenced in some sense from the listed firm research. So what the research we have all been doing, 50 years, you look at any textbook on accounting, you look at most of the research that we have all seen, how we have all grown together as researchers, everything is about listed firms, listed firms, listed firms. And so our view of the world is influenced by that. And I could see that in their review. That's my personal view on it, personal take. They could disagree with me on that. But I'm going to present something which is much more about how do you deal something which is a relatively small business. What is the role of reporting in a very small business? Maybe only one builder, a handyman running the business. What is the role of accounting in that particular context? I can talk about that, okay? I'll present a few things in those contexts. And if any of you here are under the impression private firms and public firms are similar, just change it. Except for the fact that they both are doing business, there is literally nothing else that brings them together in my view. Okay, so huge differences between them, and research has shown it as well. I don't have time to go through all these differences, but maybe if they allow me to write a discussion, I'll probably include those in the write-up. Okay? So what I'm going to do right now is present an alternative perspective to what the authors have presented. Okay? So what is the view that the authors have taken? So the authors have first fixed the definition of financial statements. What's a financial report? Okay? And they start off by asking this question, that financial statement preparation is one of the main, if not the only choice on accounting that private firms have to make. Okay? And what do they define as financial statements? Financial statements are basically defined as the 4 major statements that we are all aware. Okay? This is where I say that they are influenced, whether subconsciously or otherwise, they are influenced by what listed firms are doing, because many of these statements, income statement, balance sheet, cash flow statement, statement of shareholders' equity, they don't make sense in the context of private firms, and that is my view on it. Okay? So what the authors have done is they've taken this limited definition of financial statements, and they have asked me to, and they have just basically said, let's look at which firms will produce financial statements. But rather, what is a better view to do, in my perspective, is to be able to say, to ask the question, what is a financial statement for a private firm? Many financial statements are irrelevant for private firms, and that's what is actually shown by all these companies, like all these studies as well, Ali and Yoon. When they look at it, they find that only 10% of the businesses even prepare accrual-based financial reports. But when they ask the people, do you prepare a financial statement, many of them say yes, oh yeah, we all prepare financial reports. But financial reports for them is not even based on accrual system. So they have a different view of what is a financial statement for them. And why is that happening? In my view, again, I work with, being in London, I've had the opportunity to work with billionaires who run private companies. Couple of billionaires. I've also worked with individual private companies, actually helping them run their finances. That's where my perspective comes in. Okay, so part of it is to do with my own experience along these ways. When I talk to some of these billionaires and tell them, like, look, oh, you don't even have unearned revenues in your financial statements, they are like, oh, that's irrelevant for my decisions. I don't need unearned revenues. I explain to them what it is, and they don't think it's important for them. And similarly, when they talk about, oh, why don't you prepare a balance sheet for a business? They have one particular business where they didn't prepare the balance sheet. And they said, oh, the balance sheet, I don't make any investments. It's a logistics-based companies where all the logistics are all outsourced to others. So I don't have an investment at all in it. And I don't have any borrowing. She's a billionaire, and she just invests all the money from her own pockets. And I say, oh, why don't you have a statement of shareholders' equity? What is it? Oh, she said, oh, that will have retained earnings, your share capital, etc. Oh, it's all anyway my money, so it's all my personal bank account. I don't need that statement anymore. And this is a person who is quite influential. She runs a pretty big business, a multi-million-dollar revenue company. For them, financial statements are not that. But when I ask her, can you show me your financial statements? She shows me her cash flow statement for the business and says, this is what we tend to use. But we also know what is the cash flow we have to collect. We know what is the cash flows we have to pay out. So I've kept all that information so I'm able to make the right decisions. Okay? So that's what's happening with some of these smaller firms, more medium firms as well. And we can't even differentiate between what is tax and management accounting, because in these cases, they sometimes prepare financial statements only for tax reporting. And there's no accounting standard that needs to be used, specific standard that needs to be used for the US private firms in particular. So this distinction between management report, tax statement, financial reports, it gets murky for private firms. Often lenders don't even ask for financial statements for small businesses. Why? Instead, they'll just say, give us your historical bank statements and give us your projected numbers for the future. Because if you give me my historical statements and the projected numbers for the future, I've got the accrual information. You don't need to prepare the accrual information. And why don't they ask for the financial statements? Because it's costly for these people. Many of them don't even know accounting. And if you ask them to say, oh, prepare a financial statement, they'll just go to another bank. So it's easier for them to ask information about financials, but without putting it in the context of financial statements as we see it. So even the lender demand or the external demand for it is all limited. So rather than seeing financial statements in a fixed view, I think the better way to think about it is to think about financial reports developing for private firms based on spectrum of accounting choices. If you're a very small firm, you might just say, all that I will care about is accounts payable and accounts receivable. You get a little bit more sophisticated, they might come and say, okay, now on top of that, I'm going to include deferred revenues. And then if you become a little bit more sophisticated, they might just say, okay, I'm also going to recognize lease liabilities, so on. So it starts to change. It's not like a 1-0 where I prepare financial statements or I don't, but what goes into my financial reports starts to change. And the biggest drivers of these two choices are how much trust there is between the user and the preparer of the accounts. And the second one is how much both of them know about accounting. If the user doesn't know anything about accounting research, about the accounting terms, they're not going to ask you to prepare, oh, I need your insurance contracts. I need your fair value accounting. Nothing. That all is meaningless for these people if the user doesn't know how to use them. For want of time, I'm going to go away too. But I think it's useful for the future research to be able to see the earnings attributes. When are they using earnings, which attribute, which accounting policy, what is driving these choices. It's more about the accounting attributes and linking it to the human traits. It's no longer business complexities. It's like we want to see how much the user knows, what is their accounting knowledge, how much trust do they have with the preparer, so on. Okay? And US versus Europe on private firms. Okay? Okay, most of you are from the US here, I admit. But I have to give my European perspective on this. Okay? A lot of the research on private firms is done based on US private firms. It's US, but many more research happens on European one. But listed firm research started here. Why? Because the data was made first available in the US for publicly available companies. That's where 1960s, I remember Ray discussing with me how he had to use punch cards to have his empirical research. And that made a big difference. So naturally, when we look at listed firms, we start building on existing studies, and it all built on the US data, so on. But we don't need to do that for private firms, because the private firm data in the US is problematic in my view. It has some advantages. I'm not saying it doesn't have advantages, but I don't think that limited view to say, oh, let's use the US context is needed here. Why? Because for private firms in the US, data is based only on selections and survey, which all run into issues with selection biases. Okay? It's not available for all the companies. And even when they are reported for companies, we have got a sample of companies collected through surveys. The data is also state-specific. The requirements vary from state to state. And in some states, all that they have to prepare is only a company profile. They don't need to prepare a financial report. So what the state-specific requirements are imposed starts to vary. There is very limited regulation or even enforcement of these, which means that accounting quality can vary within the surveys you're taking. So for instance, I went into this website for Alabama State Secretary and looked at what was their business entity. I wanted to pull out a few business private firm data sets. And the first thing that has come is, it says, warning, the Secretary of State's office has recently received companies regarding potentially fraudulent business filings. And this was a surprise. But what came as the biggest surprise was the Alabama Secretary of State's office is not authorized to investigate business fraud, so which means they don't even care about the quality. You just give them a bad financial report, they will accept it. And even if you tell them that it's fraudulent, they are not authorized to do it. So if you're going to use this kind of data, there are going to be potential issues. But it's an interesting research question nonetheless. How much of it is biased? How much of it is problematic? So on. So what are my closing thoughts? We can continue to do this difference in difference analysis, right? I'm just starting to see many more of these analyses, and they're starting to laugh as well. Recently, I came across a paper which studied how the introduction of a divorce law affected earnings management in companies. Okay, and I'm like, yeah, it might be, there might be some effect, but it's not a third factor. It's like more like fifth order effect that we are talking about. But let's get an impact factor much more to be significant. And I'm not blaming the authors for doing it. Why are the authors doing it? Because the journals are saying and the reviewers are saying, we want that, we want that. If you ask for that, they will give you that. Okay, so if the journals are also starting to say, let's take a bit more of a wider perspective, let's start to accept papers which are more descriptive, but which have great insights. And private firm setting is a fabulous setting to get that greater insight. As Andrew rightly pointed out, we don't know much about 99% of the businesses in this country or worldwide, which are all operated as private companies. For them, our research is utterly useless. We are focusing on the limited set of listed firms, and that's why we need to broaden. We need to start saying, let's encourage research on private firms. Let's allow descriptive data. Let's allow innovative strategies. Let's allow innovative ways to come up with research methods. Okay? If we do all that, our impact will also be much more in this field. And I think this review paper should be part of all doctoral studies. Let the next generation start to have a much wider view of the world than just listed firms alone. And this paper, this private firm review should do a fabulous job of that for them to be able to think beyond this limited set of firms. And you look at the JFE, these days many of the finance articles, they are not based on CRISP and CompuStat anymore. They have started getting into personal finances, so on. And we don't need to restrict ourselves to the limited sample of listed firms. Again, listed firms, I'm not saying don't do it, just a matter of balancing things out. Okay? And finally, again, why didn't I cite, where was this paper? Yeah, Ramesh and his co-authors' papers. Very happy to see that kind of paper accepted in this conference, right? That's a very descriptive paper. They have a difference in difference, which you need to get your papers published, I guess. But I'm not very convinced with it, but I still love that paper. Okay? And finally, I commend the authors for writing a phenomenally good review on a very tough subject. Well done.
All right, everyone, take 1 or 2 minutes. Thank you.
Sorry.
Should I leave the slide up? Is that a good idea? I'll leave it up. Okay. You know, when you do private firm research, you're like the kid brother, and you're always fighting for attention. And one thing I'll say is there were many things that Darren and I wanted to say that Shiva said on his last slide, but we thought that we shouldn't be saying. So we're really glad that he said those things instead of us. I think the takeaways, mostly on point. The third takeaway being that we, consider the human factor in a lot of these decisions. I think that's quite important. Thinking about processing costs, learning, cultural factors, attitudes around privacy. There's promise in studying that. The observation that private firms just inherently differ across the spectrum in their choices and the nature of their financial statements, and that you can't only think of it as sort of like an indicator variable. I think that's absolutely on the mark. The first takeaway about, financial statements are not useful for internal decision making, I'm less sure about. Just to give you a couple of data points here, QuickBooks, so there are 7 million firms that pay for QuickBooks. And the main thing that QuickBooks offers is you prepare your financial statements, and they link to other modules. They help you with your inventory management. They help you with your demand planning. The AICPA in 2004, and then a recent survey that I have with Ava and Andy Call, they asked managers, why do you follow GAAP? And certainly, one of the very top responses is, well, our bank wants us to follow GAAP. But not far behind that is that GAAP helps us with running our business. It helps us with budgeting, with forecasting, and with deciding the right way to pay people. So we're not yet convinced that financial statements aren't useful for some of these managerial purposes. But to your point, there's certainly going to be some sort of size effect here. This is going to vary across the size distribution of firms. So with that.
All right, let's go to Anna Costello and then Phil Berger.
Hey, Andrew.
Hey.
Really well done paper. I also think it'll be useful for the literature, so thanks for writing it. I had a similar reaction to Shiva on the substantial heterogeneity in the sample of non-public firms. And I think you touch on it, but I do think you lose a little bit of that heterogeneity in the paper, in that, these different types of firms are going to respond differently based on their market incentives. And so the same problem we have with just focusing on public firms and ignoring private firms, you're going to have that same problem a lot in the private firm literature. And your analogy of the lamppost, I think, still holds, because most of the literature in private firms, we're grappling with getting small, sub-selected amounts of data. So, I know it's a hard problem to tackle, but I would probably lean more toward you're focusing on large private firms that are somewhat similar to the public firm setting, rather than grouping all non-public firms together and sort of making more of a general analysis of this big group of firms that are largely heterogeneous.
So I completely agree. There's more heterogeneity on the private firm side than the public side. I think the usual caveats apply when you're doing empirical research in any study about what is the right control, what is the right sample. I wouldn't say that we're only interested in firms that are sort of on the cusp of IPO or the very large private firms. And this sort of relates to our generalizability point that this is the US, okay? This is our economy. You've got firms that have more than 1,000 employees. More than 1,000 employees. They make up about 21 million of the workforce. The category right below that's another 9 million. But there's a ton of firms and a ton of people and a ton of economic output that happens up here with these like firms that have 20, 25, 30 employees. Like that's a major driver of GDP and investment. And we, I think we're careful, but we could maybe be more careful in saying that, you have to understand the nature of the heterogeneity, that private firms are a lot different than each other than maybe public firms are, and that any given study needs to keep those in mind and thinking about what is the right design for the right sample for the research question.
All right, Phil, and then we'll go to Nick Est.
Thanks. I wonder, Andrew, if you and Darren might eventually be able to push one step further on two things that you talked about that I thought were quite interesting. So one was the toast thing, and I guess there what I would wonder, in addition to the fact that this direct kind of connection into the firm's information by, say, a lender might reduce some need for financial information, I think now it's even getting more disintermediated. You probably know more than me, but there's firms, right, that will put a direct sort of information line into firms to allow the firm to just auction off its cash flow in some sense. So they're getting rid of the lender completely. I think talking about that, which I think is somewhat of a trend, talking about what that might do to the need for financial and accounting information could be interesting. The other one is, with regard to the human factor, what I would think is a big opportunity is, in addition to just thinking of it in terms of, it's not necessarily all rational economics and how you choose between different accounting choices. I would say that with these younger, less regulated private firms, what's interesting perhaps, if one can get the data, is they're probably more flexible in making choices about culture and organizational capital and how those choices relate to their. I think that would be a very interesting thing that, to my knowledge, has been studied little, if at all, in accounting. I think could be a great source of contribution.
Yeah, these are great points. So on the first one, I'm reminded of Ray Ball's PhD class, where what Ray's views are on value relevance versus the other school. And one of the jokes Ray would tell is why don't you just give them the ledger, right? Why don't you just give them the ledger? Well, we now have banks now have technology where they can log in to the borrower's QuickBooks. And I think there's an interesting question to ask is when they're not asking for the full financial statements, what line items are they getting? What do they actually care about? Because that's sort of where we're gravitating towards, is not using actual full financial statements in contracting, but just taking slices. On the human capital part, so I'm trying to remember, so remind me quickly what...
Well, just the idea that instead of thinking of it just as the human factor as maybe something instead of, economic rationality to make these choices, I think it's more that the firm is making choices about human capital and about culture and about organizational capital that probably relate to its accounting choices. And that,
yeah,
I think they have more flexibility in all those choices in the private firm.
And the other part I'll add is that I think countries just inherently differ in terms of their attitudes towards privacy. So in the US, I think part of the reason many firms are private is they don't want they don't want their neighbors to know what's going on with their business. In the UK, you get more of the sense that, because we give you limited liability, you're sort of obligated to tell us what you have. And so I think there's room for cross-country studies that look at how these attitudes around privacy relate to some of these choices around, say dissemination.
Go to Nick and then Glazier.
This might come across as a bit defensive, but all my research is on public firms. So I want to highlight a couple of advantages to focusing on them, perhaps, besides just data availability. One is that in each study, there's usually one or two things where we'd like to maximize variation, and then a bunch of other things we would love to hold constant. So it might be beneficial sometimes to have all the firms in the sample filing, or all of them facing market pressure, having analyst coverage or something. And then we can focus on the variation we care about. And then the second thing is that while they might only make up half of the economy, the public firms, more investors have access to them, and as a result, more regulatory attention focuses on them. And so it might also make sense for us to spend more than half of our research and teaching effort on what other market participants are spending more than half of their time and attention and capital on.
So I think both points are entirely fair. There are questions that you can just not really ask with a private firm setting. Anything with analysts is definitely going to be one of them. In terms of the economic size of these markets, how you measure it, I think there's plenty of room for disagreement. But one thing I'll point out is like we sort of have a view on like where the literature should evolve and what we don't know that's important. Even if you say, well, like in terms of what investors can actually access in public, that's a lot bigger. I would love to see someone deflate that by the number of accounting studies on trivial analysts' characteristics, right? Because then you're gonna that number then starts to look rather low.
So, you focused a lot on public versus private firms in the
Yeah.
review. I thought the review was very useful, by the way. But there's another margin that's really important, which is the decision to start a business in the first place. And that depends on some things that accountants are interested in, right? Like taxes and regulation and capital supply. And I didn't know if you scoped that out intentionally or what your thinking was there.
Yeah, no, I mean, I think this slice here is quite important. And by the way, these are only firms that have employees. In addition to this, there are like dog walkers and daycares and stuff where it's just run by the person. Our review is at least partly a function of what you all have done in terms of work. So if there aren't studies on it, all we can really point to is as there being an opportunity for future research. And so my sense is like as you sort of go up to the top of this table, we know significantly less about what's gone on. I mean, Shiva talked about the Ali and Yan paper. That's sort of up in this range too. Now that's from the SSBF, the survey, Small Business Finance survey that the Fed does from 2003. And so I think even though we have like little slices of data and evidence from some of these segments, it's really old, right? Like in 2003, half of Americans weren't using the internet at work, and they weren't using computers. And now we're in a world where everyone's using computers. QuickBooks has a pretty dominant market share. And so I think just like the nature of technology and how it relates to these accounting choices has changed quite a bit, and it's a promising area.
So Rich Frankel and Suhas.
It seems like the distinction between private and public might or might not be relevant depending on the research context.
Yeah, for sure.
So it seems like you just have organizations trying to survive and be profitable in an economic environment. They're subject to competition. So if we talk about fish versus birds, are they the same? Well, it depends if you want to study lungs, you're not going to learn anything about that from fish. So I don't know what if Shiva is telling me, if Shiva is saying that people don't care about accounting, I would say, well, that you're looking at a situation where it's not good to study accounting because it's not important for survival in that situation. So what I would kind of think about is what forces are different, and I think what you're saying is public listing, regulation.
Yeah.
That's an important force, and what does turning on and off that force, what implications does it have? And I think, like Phil said, I think innovation is a huge thing. Why don't we have more innovation in public company reporting? It could be securities regulation, it could be all these other things. So it depends on the question. I think there are important questions. There are other that can be addressed using private companies because we can see that innovation. It might be stifled by regulation.
Yeah. I mean, so a couple of things. Not every firm, not every industry is going to be, innovation is not going to be central to what they do. A second one is, I think this is where we're going with this management practice thing, is that there's a literature that looks at what types of firms are paying variable compensation, which firms do record keeping. They're thinking about these things like competition and frictions because we have this very wide dispersion. Chad Severson has a number of papers about this. There's a big dispersion. I think Barrios also has a paper related to this. No? All right. Is it public? All right. So there's a big dispersion of productivity across firms, even controlling for the usual suspects of size and industry. And this starts to beg the question, is like, what other frictions are at play? One of them that people talk about is competition. So if I'm like the only hotel or restaurant in town, I don't face a lot of product market competition. I might not be so optimal in adopting my making accounting choices and making management accounting practice choices either. So this is why we think that there's sort of room to bring in that view to understand these choices.
But if you seek to understand how variation and competition affects accounting, the public-private distinction is not necessarily clear. The way you've defined public versus private, you have a switch that's being turned on and off. Mm-hmm. And then you look at how turning on and off that switch affects the forces that might affect accounting. But
So is your point that we're abstracting away from the choice to be public or private, or?
No, I'm thinking that we want to look at choices along that margin. How does turning on and off that switch affect the incentives or the costs and benefits associated with financial reporting?
Okay. Yeah. I mean,
That's the clear distinction between those two groups, not whether one's more competitive than another, one's smaller than another. That might be relevant.
Let's move on to Suhas, and then we'll go to Sean Kim.
Thanks. So my question is sort of related to what Nick was saying. So first of all, let me say I'm very interested in kind of the descriptive stuff that you've presented, and I think we should have more of that. But you also motivate the paper by saying that we just, as accountants, need to understand how accounting affects the allocation of scarce resources, which is a causal question. And when we start talking about private firms that don't have regulatory requirements around the information they produce, how do we sort of think about that, the choice that they're making, and separate that out from the question that's really motivating all of this, which is this question about capital allocation?
yeah, I mean, causality is hard, right? We all do empirical research in topics that have nothing to do with the public or private firm distinction. The same issues are at play here. I think the benefit, though, of first having the descriptive evidence is it shows you at least where the variation is, right? Like if I'm interested in some management accounting practice, I probably wouldn't then go write a paper about it if I knew that every firm did it, or if every private firm did it, or if no private firm did it, because there's no variation there. If I start doing basic correlations with, say, size and the life cycle and the industry, it gives you some indication for what causal factors might be at play. But we're not sort of throwing the whole movement of causal inference and credible identification under the bus. I think what we're saying is, like, let's first establish the basic facts about what firms are doing. And that sets the seeds for theory building, for understanding these debates about standards, and then for more causal stuff. But we shouldn't just jump to the causal stuff.
Andrew, learned a lot reading this review. My question is related to the information dissemination part of your review.
Yep.
If you were to create a model or theory of voluntary disclosure for private firms, would that model look similar or exactly the same as the traditional voluntary disclosure models that we have? Or are there forces or dials that you would add or remove? Or would we need a completely new model to understand why private firms disclose it?
I think there would be different forces at play. This is a good time to plug my co-author's dissertation. So things like concerns about predatory behavior, the nature of proprietary costs differ, the sophistication. So if I just don't have very sophisticated managers, they might not be very good at making these dissemination decisions. But particularly related to disclosure, I think the way that we worry about, say, predatory behavior in competition, it just differs for smaller firms that are just more financially constrained and more vulnerable in the product markets than with big public companies. So those would be some of the first things that come to mind. I don't know, Darren, if you have anything to add to that.
It gets back to what Phil was saying before, too, about culture, I think, actually plays a big role for many of these private firms. You go and talk to people in Germany, and they'll tell you, we hate disclosure. We don't want to disclose. And you see that actually in the statistics, too, where small private firms in Germany, basically none of them voluntarily disclose an income statement. But you go to the UK, where you have essentially the same rules, and something like 15 to 20% of them voluntarily disclose an income statement. I can't explain why that's true, except for to point to culture, actually. So I think culture would have a big effect here, too.
Let's go to Henry Friedman and then Travis.
Okay, this is a very closely related question. It's basically that we have a lot of theory, both in terms of capital markets and in managerial accounting. But I think I heard a couple times through the presentation and the discussion that there's no theory in this space of private firms making decisions.
Shiva said that, but okay, yeah, go ahead. That's not what I said. Okay.
Push me under the bus.
I think I heard it a couple times, or there's very limited theory. And you answered this question a little bit, and Darren did too, but like, what are the things that stop us from porting theories that we have, and not just in discretionary disclosure, but also, like, there's a lot of managerial accounting out there.
Yeah.
What stops us from porting those over to a private firm setting? And in your answer to the previous question, it sounded like a lot of the things were, where do we sit in the parameter constellation? Or it was something like culture, which as a theorist is really scary, because, like, do we have to go back to, like, the 1300s or 3000 BC to explain variation in culture? Like, culture is sort of just like We
It's
don't
very
know
nebulous,
why,
yeah.
But we're gonna call it like a pre-existing condition.
Yeah. So I'm not a theorist, as you know. I have some good co-authors that are theorists. I'll say one observation I have is that when you read some of these seminal theories in disclosure or management accounting, I feel like they were written for private firms, right? So like whether you're a Dye person or a Verrecchia person, there's like a simple project. There's not a lot of alternative information. There's like a very simple operating environment. And then people go and take that theory to like Microsoft and these firms that have like 180-page 10Ks and 20 analysts and a very transparent information environment. So I actually think that many of the theories that maybe you're alluding to were designed for private firms. And that's sort of one of the things that we're trying to pitch in our main takeaway is that this is the right setting to test these foundational theories, because if you don't find something, it means a lot more than if you didn't find something in a public firm setting because of the variation.
Can I just clarify it?
Yeah.
Henry, when I spoke about saying there is limited private theory on private firms, I'm not aware of the management accounting literature, so that's the caveat with which I'm speaking. Sorry, should have made it clear.
Travis and Barry.
So my question, I guess, is kind of similar to what Anna brought up earlier, but it's, I guess, the use of like private firms, like categorizing it, it feels actually pretty broad, right? Is private data, like we don't know the information about these firms, and so you kind of that headlamp, that like light post story. When I was reading the paper, I was thinking about, how Robinhood is now like tokenizing private firms so you can trade them, right? So they'll buy some of that equity and you can now trade them. So anyway, I was just curious about the choice of leaving it so broad versus kind of, I maybe understand why you would want to do that for a review paper, but it felt like really broad.
Yeah, so a couple things here. So you're right, there is a distinction between private data and private firms and private firm data, right? So like Jim Hutton had private data, but it was about public firms, right? So like, in terms of, so like when you write a survey like this or about anything, you sort of have to define your terms. Like, what is corporate governance? What is disclosure? Is that the same as dissemination or private reporting? We tried to develop something that's sort of like the way that people seem to think about it in the literature, and that also wasn't so burdensome to carry through in the sense that we need to have an 8-page discussion of all the exceptions to the definition. Our preferred approach, and we're very much open to feedback on this, is like, let's sort of start with the way people talk about this, and let's talk about the main exceptions, but also have a caveat that says, researcher beware. You always, whether it's a private firm setting, a public firm setting, you got to know your data, you got to know the institutional setting. That seems to work relatively well and spare us from having this really burdensome definition that we carry around in everything. But again, we're open to feedback on this.
John?
Yeah, just to tie the heterogeneity comment one more time. I felt it was an opportunity to go like the IO literature, which is maybe we need more industry studies, especially now that you open this tank for private firms, where the constraints are kind of homogeneous within industry, and then start teasing some of that out, and maybe some discussion in the review about this is an opportunity to actually go into more industry. I know somebody here had called for more industry study.
No, this is a really good point. It relates to what Nick was saying, is if you go to one industry, you can at least hold some of the problematic heterogeneity constant.
Or variation in the constraints that you talk about.
Yeah. But as long as the editors are okay with industry studies, but I agree. Like the IO literature, you have a study on concrete, or you have a study. There's a whole yogurt literature, because by studying the yogurt literature, you can hold constant so many things and really test these theories. I think that's a good point, and we'll talk about that in the next version of the survey. Yeah.
Mark Lang and then Marcel.
Yeah, something I hadn't really thought about before. Obviously, I've read this paper a bunch of times. And it's sort of an amorphous boundary you have here. And I'm kind of intrigued by this idea of like culture mattering and human factors mattering. But I wonder how you think about the margins between like this literature and like the entrepreneurship literature. Like are some of these culture and human components best thought of as part of the accounting literature, or how would you sort of think about differentiating between when it crosses over?
Yeah, so and the path that this paper has followed, it was like pretty unwieldy when it started because we didn't really have good boundaries on it. And I think the Ray quote and the Ray essay, like this focus on the economic role of accounting, gave us a lot of those boundaries. And so if there's a study that talks about how cultural factors affect my accounting choice, I think that that's something that belongs in our survey. If it's a paper that's about how cultural factors affect my capital structure choice, just because it's a private firm, I don't think it would fit in. And so we're kind of the intersection of these main accounting choices and the economic role of accounting is the way we're trying to put a boundary on it. But it's an imperfect exercise, for sure.
But how would you think about it if it's an accounting choice, but it's primarily behavioral, right? It's just like people with certain characteristics prefer to have other people stay out of their business or something like that.
I think that belongs, and I'm not only saying that because Ed DeHaan is standing behind me. No, I mean these things really do matter, and whether it's a cultural preference or just lack of awareness. I mean, I think of. So I've been doing a lot of work on my house over the last couple of years, and I asked my contractor, how do you do record keeping? He's not sophisticated about it at all. Like he says, a lot of it I just keep up here. This is an accounting choice, and this is his sort of lack of financial sophistication that drives that choice. My take, and I think Darren's take too, is that would belong in our survey, even if it's purely behavioral.
But there isn't much in there now about it.
You guys got to write the papers. Yeah, I mean this is the future research part, and like it was his third takeaway here is that things like trust are going to have a first order effect on accounting choices. We don't have a lot of those studies yet, but we should. And if I'm missing any of these studies, definitely send them my way.
Marcel?
I want to extend one of Shiva's comment and represent the European community a little bit with some specific suggestions, which could also address Anna's and Trevor's comment a little bit. I think much of the research is done on European firms because of data availability. And it's not entirely clear in the review what your stance is on research design and extrapolation or external validity. Because from my experience, you always get asked when you write a cross-country study using a lot of European firms and exploring regulatory changes, what can we learn from this for policymaking, in particular for the US? It's not clear how to think about that because European firms are so different from private US firms. And your framework only covers the 20 to 49 kind of employee type of European firms, as you say, which is a very small part. I think you would do a great service to a big community looking at European settings and PhD students to take a stronger stance on how to think about that setting when it comes to drawing inferences for US policymaking.
Okay, yeah, so this is a tough question. I mean, I think the time for naive comparisons between country A and country B has passed, right? Like that was the early part of the literature on investment efficiency or listing decisions. I think we sort of know that, if country A and country B differ meaningfully in the industry mix, in the, all these other things, that you can't really do that. Then I think it comes down to like what exactly is the nature of the regulation and making smart research design choices. I mean, we're not saying that these comparisons aren't unhelpful, but we need to think carefully about maybe matching and subsample analyses and cross-listing and stuff like that. But yeah, you're like we can add some guidance, particularly at the end of the paper where we're talking about empirical issues, as to like how do you interpret these comparisons and like how do you get closer to the causal ideal. Yeah, no, that's a fair suggestion.
We started 2 minutes late, so last question, Kathy.
There's a big debate currently about investing in private firms and having private firms in their
401k.
And it's a big debate in Europe too, and how to deal with valuation, which is a large function of the accounting data. But can you talk about how what we know from public firms could help? What kind of information is going to be required? How the valuation part of this, which I think is a big thing that accountants should be thinking about, will play out over the next few years.
Hard to make predictions. I think this relates to Mark's question about the scope of the survey. We sort of deliberately not ignored those studies, but didn't include them because they weren't about accounting choices and the economic role of accounting. But we totally agree that this is a big issue, a regulatory issue and a practical issue on the horizon. And we can think of... Yeah, no, I totally agree. Totally agree. Yeah, we can think about whether this maybe fits in or not. Yeah.
All right, I'm sorry we didn't get to everybody, but we're out of time.